Afternoon, everybody, and welcome to the Equifax Q2 Credit Trends webinar. My name is Becky Oakes. I'm the AVP of Analytics here at Equifax, and I'm joined today by Swanama Pandey, who's our lead insight analyst, to talk you through the trends and what we've been seeing this year. So before we get started, I'm just going to hand over to Sandra, who's going to tell you a bit more about the platform.
Super, thank you, Becky, and welcome everyone. Our presenters are on camera in the media player on the left side of your screen. There's a Q&A widget just under that, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we will generate an FAQ document, which we'll send out to you in the coming weeks. Our presentation today is available in the resource widget for downloading on the right side of your screen, just under the bios section of our speakers. As well, the presentation will be available in French for download in the next few days. As you can see, each area within the platform is responsive, so you can maximize or minimize each box based on your viewing needs. Presentation will show in the middle of your screen, and as well, the session is being recorded today, and you will receive the on-demand link via email tomorrow. We have a short survey we'd like you to fill out, and it will automatically pop up at the end of the webinar. You can access it also by clicking on the survey icon at the bottom of your screen. To the right of that survey icon is a Contact Us button. Feel free to send us an email if you'd like any further information. Now let's get started. Becky, back to you.
Thank you, Sandra. So let's start off with a little bit in terms of what's going on with the economic side of things here in Canada. So as you may have heard, it's been quite an interesting period during 2021 so far. So at the start of, or kind of middle of Q1, we started to see inflation starting to rise. And this is one of the key themes we're going to have throughout the update today around what's happening with inflation, what potentially could that lead to in terms of things like interest rates, and kind of what that might mean in terms of your credit portfolios. So you'll see in that left-hand chart, this is the annual inflation rate here in Canada. And there's two lines on there. There's a blue line which shows the overall position, and the orange line which shows that excluding energy. So we did see in Q2, it peaked at around 3.6%. And then in July, actually rose to 3.7%. But that was really driven a lot by what's happening on the energy side. And you can see that on the right-hand side chart where we actually kind of break this down a little bit in terms of some of the key areas of inflation. You see that huge big blue line, which is linked to gas prices. And that's kind of one of the key drivers of that inflation. Now, there's some debate as to whether this is going to be a temporary inflation period or not. But the reason we kind of call this out is for two things. First of all, it's around affordability for consumers and what that might do in the long term around things like their ability to keep repaying their debt commitments. And secondly, it's heavily linked to interest rates, because when inflation is high for a long period, one of the ways in which you can curb that is to kind of rise interest rates. So that's really kind of the main reason why we're looking at this in terms of the interest rates and what could happen over the coming months. So on the flip side of this, if we look at what's happening from an economy standpoint around jobs, some good news is that we are seeing jobs start to pick back up again. Now, some of this will be linked to seasonality, because we do see part-time employment peak a little bit in the summer months. And you'll see in that left-hand chart, that red line, this is kind of indexed back to February 2020, so pre-COVID, what's happened on the part-time employment. And we've seen that red line start to really recover during the second quarter. The blue line, which is full-time employment, that has been gradually increasing. It's close, but not quite back to the pre-pandemic levels. But generally, it's relatively a good story. Although, like I say, there is some seasonality linked to that part-time employment piece. So the fact that it isn't exceeding February 2020 perhaps means there's still a little bit more of catch-up to do there. On the right-hand side, if we take a look at savings rate, this is one of the big things we saw movement-wise during 2020. So we saw consumers were able to start saving a lot more. And that right-hand chart is showing it's household net savings over their disposable income. So you'll see that big jump in Q2 2020, when we had the lockdowns, when we saw consumers really pulling back on their spending, and also where we had the start of some of those government support programs, and indeed some of the deferral programs that the lenders were offering. And that really enabled consumers to save a little bit more, put more aside. And that has continued actually throughout 2020 and into 2021. So you see, if you look at the Q2 bar, it's actually increased a little bit compared to last quarter. So that is good news in the sense of consumers have got more money put aside potentially to kind of weather the storm if need be in the coming months. So that's all great, but as we kind of know, some of those government support programs are still in place, and some of that kind of support mechanism is really helping some of those consumers. So what we are starting to see on the credit side is really important, because as that may change over the coming months, that's really going to be the big talking point for kind of Q3 and Q4. So if we move into the overview on the actual credit side of things, probably no big surprise is that mortgage is going to be a key theme we're going to talk to you about today. The mortgage market has been really quite high. We've seen lots of growth. We're seeing hot housing markets in plenty of regions. So we're going to be talking to you about that. And you can see on the slide in front of you on the right-hand side, the average mortgage debt, it is up Q on Q, it's up year on year in terms of what we're seeing for consumers with mortgages. On the non-mortgage side, and this is where we saw quite a lot of decrease in terms of usage during the pandemic, we are still seeing that we are down year on year on the non-mortgage debt side. So you'll see about 1.6% when we look back compared to Q2 2020. We are seeing a bit of an increase compared to Q1 though, and we'll talk to you a bit about kind of where that's coming through. Some of that is going to be seasonality again. We do see sometimes credit picks up a little bit in the summer months or kind of in the spring period. So that will be linked a little bit to the seasonal impact, but it kind of is still down compared to pre-COVID. When we look at the stress indicators, so delinquency and insolvency, good news is that delinquency is still really down, both compared to last year and compared to last quarter. And insolvencies, again, they are still down compared to last quarter. We did see a bump last quarter, and that was linked a little bit to what happened with some of the deferral programs. And when they stopped kind of in Q4, there was some increases that started to come through, some temporary financial stress. That was temporary. So that's the good news in terms of what's happening on the insolvency side. We are up compared to last year, but that's, again, Q2 last year was really low in terms of insolvencies. But we will kind of talk to you a bit more around what's happening on that insolvency side and some of the movements that we're seeing there. So in terms of kind of the three main talking points, I guess, in terms of our themes for the Q2, as I mentioned, the housing market, April was really strong in terms of the housing market. It did start to pull back a little bit in May and June, but those mortgage levels were really high, again, particularly in certain regions. A second thing that's really important for the Q2 side, we're starting to see a little bit of movement on variable rate product usage. So if you saw a press release a week or so ago, we do call out Helocs in particular. There are some areas where Heloc growth is really starting to pick back up again. And again, that's a variable rate product. So linked to that piece around inflation and what happens if interest rates rise, that could potentially create some stress for certain pockets of consumers in future. So that's just one to watch. And then on the insolvency side, although those levels are still down compared to where they were pre-COVID, we've seen quite an interesting shift in terms of what's been happening around consumer proposal usage. And actually, there's kind of been more kind of growth in terms of when consumers are going insolvent, they're choosing proposals over kind of the bankruptcy route. So we'll kind of talk to you a bit more about that. So if we take the overall view, the total consumer debt reported to us is standing at 2.15 trillion. As I mentioned, the growth we've seen in that is around 7.5% year on year, but that's mainly driven by mortgages. So you can see that on that left-hand chart, mortgage growth is up almost 11%, whereas non-mortgage is actually down 1% compared to Q2 2020. Again, it has increased a little bit on the non-mortgage side compared to last quarter, though. So we're starting to see some of those balances starting to creep back up a little bit. In terms of where that movement is year on year, on the right-hand side, you'll see the product view that we have here. So installment loans, that's where we actually have seen continued growth when we look at it compared to last year. And then you'll see kind of the big losers in terms of where that balance has dropped off. So cards and unsecured lines of credit, some large movement in terms of the balances coming down compared to a year ago. And again, a lot of that is reduced usage. So credit cards during lockdown, people weren't booking vacations, they weren't spending as much. But we really saw an increase in payment behavior. And that's kind of what's driven a lot of that balance down was consumers, whether it's from the government support programs or maybe from the deferral programs, giving them the ability to kind of choose which debt they pay down and when. We've seen those balances really start to reduce. On the Heloc side, you'll see that's down 0.1%. But again, we have seen some big growth in the last quarter. So that's kind of one of the talking points that we'll be going into in a bit more detail. Delinquency-wise, so as I kind of mentioned a bit ago, when we look back at Q4, when those deferral programs ended, you will see on the left-hand chart, we started to see a little bit of an increase on the delinquency side, and thankfully that was temporary. So we did think at the time it likely would be. Those deferral programs ended, and there was a little bit, some pockets of stress started to come through. That has leveled back out again, and actually we've seen delinquency fall again this quarter, which is really good news. We do still wonder what's going to happen when those government support programs, when they fully end. So we are expecting to see delinquencies maybe tick up towards the end of the year as those programs pull back a bit more, if that is the case, and they do that. On a product level, on the right-hand side, you'll see again, most of the products are completely down year on year, and indeed quarter on quarter. So, we are still seeing this really across the board in terms of the reduction in delinquency, which is good news. On the bankruptcy side, as I mentioned, this is down compared to pre-COVID levels, and it is down compared to last quarter. So you'll see on that left-hand table, it's down almost 5% compared to Q1, where we had that bump from the deferral programs ending. When we look at it at a regional view, though, we can see kind of out east and out west, we are seeing a little bit of an increase compared to last quarter. And although it has increased compared to year on year, that year-on-year piece is really starting from a very low point. So Q2 2020 was very, very low, and that's kind of why we're seeing those increases. Compared to pre-COVID, it's really down still. That right-hand chart, though, that's the one which is quite interesting for us. So the grey area, this is the percentage of insolvencies which are consumer proposals, and you'll see that big shift towards the usage of these as an insolvency route compared to, say, back in 2015. So it's increased from around 47% up to close to 70% during the COVID period. And it did definitely increase during the COVID period. And some of that is going to be, you have consumers that historically maybe have been very strong from a credit standpoint. They maybe had assets to protect. And that's one of the reasons why they maybe are choosing that route. And it is potentially something that we could see in the future months as well if stress starts to come through. So kind of why do we keep talking about insolvencies? So again, linked to those interest rates, and I know we've mentioned this in some of our previous webinars, when we look back in time to a similar period in terms of low interest rates, a hot housing market, people starting to use Helocs more, that kind of takes us back to around 2017 through to 2019. And this is where we had similar situation to what we have right now with those house prices and with those interest rates. And what we saw is that when interest rates started to rise, we saw a more growth on the insolvency side in comparison to delinquency. And typically those things stay pretty much in line. So that left-hand chart, you'll see the red line is the change in bankruptcy rate and the gray line is change in delinquency. And you'll see that separation that we've highlighted. This was when interest rates last rose from a very low period and what happened. And we generally saw more insolvencies come through on certain populations. And when we dug into them, they really were consumers that had a lot more high balance variable rates. So consumers with Helocs, things like that. And so that's kind of one of the reasons why we are calling this out, which is there is potential that if the inflation leads to higher interest rates over back end of this year into next year, maybe take a look at your portfolios, because there could be some pockets in there which historically have been very strong, and actually they could be starting to maybe overcommit on some of those variable rate products. So it's just one to really call out. And then just quickly looking at credit scores, that is something we get asked quite a lot during this period. We know during 2020, we saw average credit scores increase. So you'll see on that left-hand chart, between Q2 2019 and Q2 2020, on average, they were up almost 9 points when we look at our Equifax score. And again, that was really driven by those changes in behaviors, less spending, less credit demand, reduced delinquency, that led to those increases in average score. And then when we look at kind of where we are in Q2 2021, after a period where it sort of flattened a little bit towards the end of Q4, again, when those deferral programs ended, it started to tick back up again a little bit, and we're seeing average scores increase again. So we're now, in total up around 10.5 points compared to where we were pre-COVID. So generally this is good, but again, it's always one to call out because this is really linked to an unusual consumer behavior period. So it is just one to watch around when you look at things like your cutoffs and things like that. Just make sure that you're really evaluating who's in what pocket there. Okay, so that's kind of the overall view in terms of what's going on with the general kind of trends. I'm going to hand over to Swanima, who's going to talk to you through the credit cards. Swanima.
Thank you, Becky. So let's talk about credit cards. So credit cards have been the worst impacted credit product during the pandemic. We saw credit card debt fall dramatically in Q1 2020, and it continued to fall down till Q1 2021. It's only in this quarter that we see a small rise in credit card balance from the last quarter. And the biggest movement in credit card balance is coming from low-risk consumers with 750 plus credit score. So this is the consumer segment that was least impacted with the pandemic, with the lockdowns, and they are the first to resume their credit card balances to pre-pandemic level. Another segment where we see a slight increase in credit card balance is the 65 plus senior segment, but their balance is not up year over year. It still shows a quarter-over-quarter increase of 6%, and that too among high-score consumers. So these are the two consumer pockets where we are actually seeing first signs of credit card balance increases. Now let's see how consumer spend behavior has impacted card balance growth. So credit card spending dropped in Q2 2020 following the pandemic lockdowns. And unlike credit card balances, we saw that spend started to rise back up and is now back at the pre-pandemic levels for all score groups. But we didn't see the same movement in credit card balances. And that's because consumer payments started exceeding the spending. As mentioned by Becky earlier, average disposable income increased for a lot of Canadian households, and they were able to pay back their credit card debt more easily. If you look at the chart on the right-hand side, we clearly see how payment rates have brought down delinquencies as well as revolving behavior among consumers. So the blue line shows the 90-plus delinquency drop. So that shows around 12% drop from the pre-pandemic period of Q2 2019 to the current quarter, Q2 2021. And in the gray line is the percentage of revolvers. So consumers who pay their balance, who don't pay their balances in full. And that showed a much bigger drop of 23%. So more consumers are paying their credit card debt in full, resulting in lower credit card balances and lower delinquencies. Now, another major impact that we see is on new card volume growth. So new card volumes dropped by 68% in Q2 2020 when compared to Q1 2019. Now, this was one of the biggest drop in new volume in any credit product that we have seen. But it is slowly recovering back as consumers are getting back their credit appetite. So when compared to the lows of Q2 2020, we see over 100% increase in Q2 2021 volumes. But it has still not reached the pre-pandemic levels. So to see how credit card volume get impacted or in the future in Canada, we also looked at other regions to see how credit card growth was affected. So on the right-hand side chart, you see 3 lines. One is Canada, one is Australia, and UK. So we are looking at credit card volume of all these regions indexed at a pre-pandemic period, which is Q4 2019. So we see a similar drop in credit card volume, and then it slightly starts increasing. But despite the fact that Australia and UK both their economy opened before Canada did, and yet you don't see the same movement, a higher movement in credit card volume. So we anticipate a longer period for credit card recovery in Canada. So before we go to a quick poll on credit cards, I would like to touch upon some key opportunities and risks associated with credit cards. So opportunity-wise, credit card spending is back, credit demand is increasing, so it's a great time for lender to target their marketing activities towards consumers seeking credit. This is also an opportunity to get more innovative with credit products. So incorporating a very popular feature like buy now, pay later for many high-ticket items. As we have already seen that some lenders have started doing that to prevent competition from buy now, pay later products. So there are potential risks too. So credit card payment rates are really high right now, and a lot of this is owing to the government stimulus, but once it ends, we might start seeing a rise in debt levels. We might see the rise in delinquencies. especially among consumers who were financially stressed before the pandemic. And with travel restriction easing and border opening, this will create more demand for credit card, and you might see a bigger increase in competition in the market. So these are the key trends that we think will have an impact on the market. We would love to know your opinion about what concerns most, what would be the biggest impact on credit card. So here's a poll, and I will give everyone a couple of seconds to answer the polling questions. Okay, so I hope everyone has answered the questions. So let's see what the results are. Wow, so almost 100% of people think that ending of government support will have the biggest impact on credit card payment rates, and that's the most that will impact the business. Okay, so this is a trend that we will continue to monitor and will provide an update in our next webinar. Now, another non-mortgage product that I wanted to talk about was auto and what has been happening in auto market. So unlike credit cards, new auto finance and bank loan volumes are back to pre-pandemic levels. In Q2, they saw a big drop in volume, but not as like credit cards. But we see a bigger recovery as well, and most of the volumes are almost back to pre-pandemic levels, and especially leases. So leases saw a 45% drop, which was the biggest drop in auto loan segment. And then they also had a recovery of 88%. So new lease volumes are up 88% when compared to Q2 2020. So one of the reasons for high leasing activity could be affordability. So high car prices, lower interest rate can make lease a more appealing option for many consumers. And if you see on the chart on the right-hand side, that yellow line shows the new lease balance share, which has been increasing pre-pandemic. It had a small drop in Q2 2020, which was the peak pandemic period, but now it's back up again. So we talked about high car prices. So we are also seeing a rise in average loan amount on car loans ever since the pandemic started. So a lot of that increase is because of the limited supply of parts and vehicles, which has been pushing the car costs up, and hence increasing the average loan amount for auto and bank loans. The auto leases saw an year-over-year increase in this quarter, but it's still lower than pre-pandemic highs for auto lease. So it's still a slightly cheaper option for a lot of consumers. But average loan amount for new banks, it's the highest it has ever been. So it's around over 30,000. So there are regional differences as well in new auto loan amounts. You see, like in the chart on the right side, you see that in prairies and Atlantic provinces, we see a big rise in auto loan amount in Q2 2021. But that also because we see a much bigger drop in Q2 2020 for these provinces. But for provinces like Ontario and Quebec, average loan amount for car has reached the highest it has been in the last 5 years. So regional differences can be a key factor in auto pricing and adjudication process. So similar to other credit products, we are seeing that delinquencies have continued to drop for auto since Q3 2020. So despite fewer deferral programs offered by non-bank auto lenders, we did see auto delinquencies have not risen since the peak pandemic period. But what's important to note is the pre-pandemic period. So if you look at the chart on the left side, you see how auto delinquencies were on the rise all through 2019, and it reached its peak in Q2 2020. And when you look at the chart on the right side, it compares auto loans with comparable bank loans. And in general, auto delinquencies have been low. But in 2019, we saw that the graph kept getting smaller. But when pandemic started, the whole trend was reversed. So now we are seeing auto delinquencies and bank loans all going down. So a lot of consumers who would have otherwise defaulted on their loans were able to pay off their auto debt using either SERP payments or other government incentives. So just to summarize up the key points on auto finance, auto demand is back to pre-pandemic levels. So, and as we see more demand will increase as the borders open, new to Canada consumers come, We can also see more demand from small business owners as the economy starts to recover further. And again, the lower interest rates may also mean that increasing growth in new volume, as many consumers would try to secure these deals before the rate goes up. So the risk associated with it is, again, a high rise in disposable income and savings rate could lead to auto early payout, which means consumers may end up paying their loans before their term finishes. So increasing car prices and interest rates leading to more competitive pricing. And the last concern is, again, around what will happen once government support ends, especially for financially stressed consumers. We could see a rise in delinquencies for certain consumer segments. So now we have another polling question. So which of these factors do you think will have the long-term impact on auto market? So I'll give everyone a couple of seconds to answer the questions. Okay, so I hope people have answered the questions by now, and I'll move on to the next slide to see the results. Wow, so I think delinquencies is one of the biggest concern for most people, especially we are seeing such low delinquencies. And so 50% of auto delinquencies, the rise in auto delinquency pre-pandemic is, again, the biggest concern. And the other biggest concern is the competitive pricing. So we'll definitely closely monitor these trends and provide an update in our next webinar. Now I'll hand over to Becky to talk about mortgages.
Thank you, Swarnima. Just before we go on to mortgages, I know there are a few questions coming through, so we can definitely go through a few of those. So we had a question back to that change in the insolvency and delinquency levels back in 2017 through to 2019. Can you highlight any patterns or common features you observed? So Helocs for one, high levels of Heloc balance. They tended to be older consumers, which was a little bit unusual, and kind of one of the reasons why we actually spotted it and did a deep dive into it was that generally these were very strong credit consumers, or where we saw the biggest movement in insolvency, they tended to be historically good performing consumers from a credit score standpoint. We did see a drop in credit payment behavior. So we started to see over time, before those insolvencies came through, they started to reduce how much they were paying on their credit card, things like that. So that was kind of one of the 2 or 3 things that we kind of really looked at. And it's one of the reasons why we kind of continue to monitor that going forward. On the auto side, I saw there were a few questions. There's a question around what's included. Is it lease, auto? So the way in which it's reported to the credit bureau, we do see kind of some of the captives. So we do see particular lenders that are very auto specific. On the bank side, they tend to get rolled up with installment loans. So sometimes when you see some of our installment loan numbers, they do include potentially auto loans in there as well. So we sometimes use a proxy, which is kind of some of the more high value elements in there. And then there's a comment made, I wonder what will happen now that new cars are harder to come by and consumers have to get used vehicles. And that's a great point. If you read about what's going on in the auto market, there definitely has been increases in terms of used car prices. And potentially that's why we're seeing some of the increases on the bank loan side. So when we look at installment loans, again, because used prices, they often tend to get rolled up a little bit more often in some of those elements as well. So there's just a few questions. Please do keep the questions coming in, and thank you for taking part in those polling questions. It's always hard to kind of judge exactly when to move on because the system takes a bit of a time, but we definitely will kind of circulate afterwards those polling results if you're interested. So moving on to the mortgage side, and as we kind of mentioned, this is really around those high levels that we've been seeing. So there's a few reasons why the mortgage market really is as hot as it has been in the recent months. So interest rates are a key driver there. So whenever you have low interest rates, you are going to see consumers taking advantage of those and potentially refinancing, maybe taking it as an opportune time to renew and kind of really get lower rates. And if you go back 5 or 6 years where we had another period of growth in the housing market and prices were fairly high, interest rates, again, were quite low back then. So potentially having another period 4 or 5 years later where you have low interest rates, that may have helped some consumers out because they're able to renew or refinance at a low rate where otherwise there may have been a risk if interest rates had been much higher. So that's kind of one reason. Second reason, there is going to be an element of investment or investors kind of coming through whenever you have a market with rising house prices. Again, we saw this kind of looking back in 2015, 2016, where we saw big jumps in house prices. We saw an increase in terms of the percentage of new mortgages or kind of consumers that had multiple mortgages. We've seen that start to increase again during COVID and into this year. So that is another reason why we have such a strong market. And then again, there is just the piece around certain regions are particularly buoyant right now when you look at what's happening with house prices. And COVID may well be kind of one of the drivers behind that. Being at home is so much more important to consumers now. We are seeing people invest more. We're seeing renovations, things like that going on a lot more. So the house has become like the new vacation almost for a lot of consumers. So again, that might be another reason why maybe consumers are buying second homes or potentially upgrading during this period. So when we look at the actual data, you'll see on the slide, that left-hand chart, this is the new mortgage volume and the average new mortgage amount. You can see kind of when that stress test was introduced back in 2018, it kind of cooled it a little bit for a period. But then you see that big jump in Q2. So we really did see new mortgage volumes really kind of pick up, particularly in April, as I mentioned earlier. And on the right-hand side, you'll see this is where we try and monitor as best we can of those new mortgages, how much of that is renewals, refinancing, how much of that is first-time home buyers. And it's not always a perfect metric, just because sometimes when it gets reported to us, we can see a bit of a lag in terms of when one's opened and one's closed, which is why we're only showing it up until May here. But renewal has definitely been still very strong in this period. We did see home buyers pick up a little bit. Again, that's quite seasonal. We often see that kind of growth during this time. And then on the average mortgage loan amount, that's really where we saw kind of some of the biggest movements. It's up 22% compared to last year. So again, the amount of mortgages that consumers are taking on, that has really increased as a result of what's going on in the market right now. So when we look at this in a little bit more detail in terms of from a regional standpoint, you see that left-hand side, this is kind of looking where we were last year versus this year. And you see kind of those dark coloured bars, that's really growth that we're kind of seeing in the Q2 2021. And it is across a lot of different regions, primarily kind of, we're seeing it in BC, we're seeing Alberta, Ontario has been very strong, but it's really kind of across the board. And again, it's a real mix in there in terms of some of these are consumers who are moving house, some of these are consumers who are just taking advantage of those interest rates because they're low right now. Some of them are first-time home buyers. It's just there's kind of growth we're seeing across almost all of those segments. Right-hand side, just to kind of call out low-scoring consumers. Now, the vast majority of people who are taking mortgages tend to have fairly good credit scores already, just because they are buying a house and they have to have a certain level of income and things like that. But what we have seen is that as we've seen those average mortgages increase, it's fairly consistent across score groups, even in the lower scoring consumers. Now, that's good news for the consumers because there's still that access to be able to kind of buy properties. Again, just call out a little bit because, again, lower scoring consumers potentially could be more affected if there's a period of downturn coming. And we all know it's a bit of an uneven period and we're not quite sure on certain period what might happen later in the year. But yeah, so we are seeing kind of similar rates of growth across all of those score groups. But the interesting thing when we talk about some of these increases, like the average new loan amount going up by 22%, when we look at payments, the payments have not grown by the same amount. And again, interest rates played a massive role in that. So if you look at that left-hand chart there, you can see looking kind of 2019, 2020, 2021, the change in terms of what we see around average mortgage amount and the change in terms of monthly payments. So going back to Q2 2020 as an example, we saw year on year the average loan amount was up 11.5%. However, payments actually dropped slightly. And again, that's linked to some of these interest rates, enabling those monthly payments to be much lower, even if they're taking on additional debt. Q2 2021, again, similar. We kind of saw 20% growth in terms of new loan amount on mortgages, but actually the monthly payment amount is only up almost 12%. So again, that's part of the reason why when we see some of this growth, we're kind of concerned in the sense of long term, what could that mean in terms of payment schedules if interest rates go up and you're on a variable rate mortgage, or maybe in 4 or 5 times, if interest rates are not low, what will happen when it's time to renew? But generally, right now, that's not too much of a concern because payments aren't going up by the same amount for these consumers. So their ability to keep making those payments on the mortgages is probably fairly good. When we look at this provincially, again, we do see a little bit of movement in terms of areas like BC, where perhaps that difference between growth in loan amounts and scheduled payment amounts maybe isn't as big as, say, something like Quebec, but that may just be linked to kind of some of the prices being much higher to start with, so your impact won't be as great there. So that's kind of what's going on with the payment amounts and things like that on mortgages. If we look at delinquency-wise and we look across Canada, you'll see in that left-hand chart a lot of green. So this is where we're looking at what's happened with mortgage delinquency in each of those kind of provinces, and it's down pretty much across the board. We do see a little bit of a jump in Nunavut, but the rest of it is fairly stable. And now one of the reasons that we need to be a little bit careful about delinquency rates and the way in which it's measured is these are balanced delinquency rates. So what can happen is that when you have a period of growth in terms of the balance, that is actually your bottom number of a equation. So your delinquency rate is effectively balance of bads over your total book. So if your bottom number is growing right now, that will reduce your delinquency rate anyway. So we have a couple of things impacting those delinquency rates. You have the low levels because of the deferral programs, the government support, the ability of consumers to kind of make payments right now. And we also have a growing portfolio or growing book, which effectively means that delinquency rate will appear even lower temporarily. So just one to watch, because when that starts to come back again and even out, you might see a little bit of increase coming, which probably wouldn't be too much of a concern in the short term. But again, just one to be aware of when you look at a balanced delinquency rate. And then, as Swanma mentioned earlier, we are keeping a really close eye in terms of what is going on across the rest of the world. So you'll see the chart on the screen right now. This is, again, we are looking at what's happening with those 90-plus mortgage delinquency rates for Canada, which is the red line. We have Australia, which is the grey, UK dark grey, and New Zealand, which is blue. So the two lines that are really interesting to us right now are really Australia and New Zealand, because a lot of their government programs did kind of pull back quite a lot towards the end of 2020. And you'll see kind of on both New Zealand and Australia, they did see a jump in delinquency on their mortgage book in Q1. It's kind of stayed fairly stable, though, for Q2. Now, there are a few programs still in place, but it's a lot more reduced compared to where it was. So this in some ways is a positive, because we're not back to pre-COVID levels in those regions. Canada, of course, we are still dropping our delinquency levels again, because we still have a lot of those support mechanisms in place. But this is really just an early warning that we definitely probably should expect an increase in delinquencies when those programs end. But we will keep monitoring this, because obviously it's a really good indicator in terms of what could happen in Canada down the line when those programs come to an end. So when we mentioned again about Helocs, so we talked about Helocs a little bit earlier on, you'll see that left-hand side chart. This is the new Heloc numbers and some of the utilization levels that we're seeing. You'll see that big jump in Q2. Now, we'll talk a little bit around where some of that is coming from, because some of it will be linked to consumers renewing, refinancing their mortgages and moving some of the Helocs at the same time. But we definitely saw kind of growth in that Heloc book. And that's one of the call-outs that we had, again, because it tends to be variable rate, it tends to be high balance. We saw back in 2017, 2018, 2019, when interest rates rose, we saw stress coming in for some consumers with high levels of Helocs. That's kind of the reason why we're just putting a bit of a caution on there around this isn't necessarily bad growth. It's just one to be aware of if interest rates do go up, and if you are forecasting, you should be thinking a little bit around this, around, okay, are these consumers going to be stressed if interest rates go up? Now, because we have some of the savings levels are much higher than they were, that could well be the saving grace here. So even if that does happen, interest rates do rise, it may be some consumers are protected to some extent because they have put more savings aside compared to where we were, say, 3-4 years ago. But again, just one to watch. And on the right-hand side on the charts, I know I mentioned this a bit ago, when we're looking at what caused some of those insolvencies or kind of some of the early warning signs back in 2018, you'll see that payment rate drop. So that red line, this is the credit card payment rate, and you see it fell quite significantly prior to those insolvencies starting to rise. And it was a bigger drop on some of those consumers with Helocs or high rate balances. You actually will see on that chart as well, which is really interesting, just how different that payment rate is during COVID. So towards the end of that line, those huge tick-ups in terms of payment rate. Again, that's one of the reasons why we're seeing such low delinquencies right now, why we're seeing scores increase, because consumers are just paying off at a far higher rate than they were prior to COVID. So again, just quickly on the Heloc side, that left-hand chart, we just tried to pull apart a little bit. When you're looking at new Helocs, where are they coming from? Are they coming from where you've also had a mortgage renewal at the same time, or refinancing, or have they bought a new property, potentially for renovation purposes? Almost 2/3 actually don't seem to have a new mortgage linked. So some of that growth we are seeing is definitely just natural incremental growth that we're seeing on the Heloc side. Again, we have some pockets of consumers really increasing their Heloc balances, and we have others who are paying it off at a far quicker rate. So we are seeing some very uneven behaviours coming through on that Heloc side. And we're also seeing that unevenness on the provincial side. So when you look at the right-hand charts, this is looking at overall Heloc balance year on year, so Q2 2020 versus Q2 2021 provincially, and looking at what's actually happened. And you'll see those two big bars in red, Quebec and Ontario. That is where we are seeing the year-on-year incremental balance growth really come through, versus, say, an area like Alberta, where we're seeing far more pay down and we're seeing far more reduction in terms of Helocs. So there is kind of certain provinces starting to show slightly different behaviours through this period compared to maybe some of the other provinces as well. So again, if you're looking at Helocs, just start thinking about what's happening at a provincial level as well, because we are seeing some differences coming through. So again, just in terms of opportunities and risks, I mean, obviously opportunity-wise on the mortgage side, interest rates are still low right now, so there's always going to be continued renewals, refinancing opportunities to come through. There's also, you know, we are seeing very low delinquency rates right now. So far, things are looking fairly good, so that's kind of good from a mortgage and Heloc standpoint. But again, on the risk side, interest rates, I know we called out last quarter, we're calling out again. They're still low right now. Just be thinking about what happens in your portfolio if those interest rates do start to creep back up again. Do you know where there is potential pockets that could become stressed? And what are you thinking about how to deal with that if that was to happen? And again, like K-curve recovery, again, it's a little interesting one because we're still seeing COVID isn't yet behind us, although vaccination rates are really good, you know, and we are still seeing an evenness in some of the business side. That's going to impact some of the consumer levels as well. While that government support is still in place, I think that's protecting to some degree some of the potential impact we would otherwise be seeing. So again, when that ends, will we see more of a K-curve recovery come through? And just being aware of how to kind of adapt your strategies during that period is really important. So that's kind of just an overview of the mortgages and Heloc side. I don't know if we want to just see if there's any more questions that have come through. I don't know, Swanama, is there any questions come through?
There were a couple of questions which I answered, and a lot of questions you already covered in your slides. So I don't have any new questions in.
Okay. All right. Fantastic. So I guess just key takeaways. I think we're doing good on time for once. Normally we go right up until the hour. So key takeaways, they actually haven't changed too much compared to what we had last quarter. Consumer behaviours, there are some interesting differences we're seeing. This is a really unusual period. It continues to be like that. You know, we are seeing certain pockets of consumers really kind of changing their spending habits and their payment behaviours through this period. Again, we do expect maybe spending probably has bottomed out in the sense of probably, you know, we are expecting to start creeping back up again now. We are seeing some demand shift in terms of products. And as Swanama mentioned, the credit cards. I think Quebec was particularly big in terms of new credit card issuing in Q2. So again, just keep looking at kind of what's happening with those behaviours in your portfolios. We always advise that segmentation is really important when you're looking at your portfolios. And while you're doing that, those pockets of stress. So again, geographical regions, are there certain areas where we know they are still being heavily impacted by COVID? Do they still have lockdowns in place? Are they heavily reliant on tourism? We know the borders are starting to open up, but it's still dramatically reduced compared to where it was. Some of those may take longer to recover, and that still remains really important to kind of figure out what that means for your portfolio and how you would then manage through that period. Interest rates, I can't say enough. Interest rates is one that we are definitely keeping an eye on. Have a look at what's going on with variable rate. Variable rate doesn't necessarily mean bad. It just means making sure that you're very aware in terms of what might happen for certain consumers if interest rates do go up. And kind of making consumers aware of that as well is really important. And are there any segments that maybe are particularly sensitive? And if so, just thinking proactively around, okay, well, if this does increase, have I forecasted for that? You know, is there anything I can do to kind of assist that consumer in the short term? Maybe a switch off a variable rate product to something more fixed during that period. Things like that are just potential strategies to kind of have in your armory down the line in case those things happen. And then again, I know we saw it in the polling question as well, where I think there was a majority around government stimulus. You know, as that pulls back, that does remain the biggest potential risk I think we have for this year in terms of what impact that will have. And it's a real unknown because we think there'll be a big impact, but it's really hard to kind of tell. We obviously are hoping it's going to be minimal, but again, it's just kind of one to really keep an eye on in terms of the coming months. So that's kind of all I had. If there's no more questions coming through, what I will just share with you is we do have some other webinars coming up. We have a fraud webinar, I believe, and we have a commercial webinar coming up where they're going to be really digging deeper into what's happening in those two areas as well. I think they're next week. So if you are interested, then please do kind of visit our website and kind of register for those. I know they're going to be really good sessions, so definitely worthwhile. And apart from that, I just want to say thank you. This has been a bit of a whistle-stop tour for the Q2 numbers. If you do have any additional questions or anything after the event, feel free to reach out to us or kind of some of the sales team. Always more than happy to kind of give you some information. But apart from that, thank you so much, and hopefully we'll see you for the Q3 session coming later in the year.